Hi everyone, good evening. You're watching The Money Show as a part of ET Now's Rise with India programming. I'm Mubina Kapasi, and yet again it was a day where we saw absolute carnage on the Lal Street. The Nifty and the Sensex continued their downward journey. In fact, the Nifty shut shop at the lowest level in the last 3 years. Early 2017 is where we saw the Nifty at that level of roughly about 85 or 100 rupees. Ditto is the case with the Sensex as well, and most of the stocks too have seen the largest crash in the last few years. Brokerage as well, like Nomura, Bank of America, have slashed their Nifty target for the year end and even the fiscal end, in fact, March 2021. And I'm sure it's something that's got you guys as well worried about what it means for your mutual fund portfolio. Well, guess what? We are going to be answering just that. Any questions or queries you may be having, in just moments from now, you can call in and you can get your questions answered. Also, the one pandemic that's worrying all of us is coronavirus. Turns out Digit Insurance has released an insurance policy dedicated just for corona. We're going to talk about that. And finally, in the last segment, we're going to be talking about how the virus has affected the prices of components of various technological products and gadgets. So does that mean prices will increase, decrease? How will it go? We'll talk about that. Well, first up, I want to address something about the markets, a phenomena that we have seen in the past as well, and it is being repeated, and that's the big fall that we have witnessed. Well, firstly, guess what? This is not the first time that we are looking at an epidemic. In the past as well, we have seen SARS, the avian influenza, Ebola, Zika, all of them hit the world in a sort of an epidemic. So let's look at the market moves that we have seen during the times of these epidemics and pandemics. SARS lasted between Jan and March 2003, shaved off almost 10%, and post that the next 6 months markets fell another 45%, owing of course to the whole 2003 crash. The avian influenza was there for a good 8 months, during which period markets fell 12%, and again 6 months following that we saw a 29% fall come by in the Indian equity markets. Later we also saw the Ebola. Again, duration of the epidemic was just 2 months, but there was a 28% rise seen from March to August 2014. So like I said, this is not the first time that we have seen an epidemic of this sort. Unfortunately, this may not be the last time as well. So just thought of getting in some data for our viewers to understand that, look, mutual fund investors have gone through this tide in the past as well, and unfortunately, if it's not an epidemic, it may be some other sort of crises, but there would always be some or the other fluctuations that may hit your mutual fund portfolio that may make you feel that you're losing money in the equity markets. And that certainly seems to be the case right now, especially if we look at how some of the mutual funds have performed. A 30% drop in NAVs as well has been witnessed in the last 1 month. Nippon India, for that matter, has seen many of its mutual fund NAVs decimated amidst this market carnage. HDFC tax saver funds as well have tanked in double digits. A whole host of funds have tanked more than 20% in terms of their net asset value, or the NAV, just in the last 1 month. So like I said, there's carnage all round. But the question is, should you keep calm? Should you decrease SIPs? Should you increase SIPs? Should you put a pause on it? We will get that question answered. We have with us today on the show Mr. Lovaii Navlakhi of International Money Matters. Thank you, Mr. Navlakhi, for joining in. You're in Bangalore and I hope you're keeping safe. I'm sure you as well have been practicing social distancing, quarantining yourself, but I'm sure that's not stopped your clients from calling you, texting you, WhatsApping you, email you, all their questions about how their portfolio is doing and should they not put their money anymore in the markets, Mr. Navlakhi?
Yeah, Mubina, thank you for having me. And, I'm attempting to do this from home. So apologize for any disturbance that you might hear. As we all know that we have all been forced to be quarantined. And as you rightly said, I think clients, of course, have been worried. But I think they've also understood, the more experienced clients, that this pace and the force with which the markets and the impact has sort of taken place, it's very difficult to sort of stop the tsunami. So what our sort of advice to people during such times is that, really there may not be a necessity for you to take immediate action unless you do not have money for your needs that are coming up within the next 6 to 9 months. Uh, I think that that's the first thing that you need to protect, that if there is a liquidity requirement in the next 6 to 9 months, make sure that it's in a safe place. A safe place could be in your bank, or it could be in liquid or overnight funds, in mutual funds. And that's something that is going to allow you to make sure that your short-term needs are met. Beyond that, I think we have to understand that this impact of this fall is not really just the coronavirus. I think people seem to have forgotten that the trigger for the fall in the markets actually started off with the problem with the OPEC countries, where the oil, the fight between Saudi Arabia and Russia and maybe US got caught in the middle of it all, where they decided to increase the capacity of production, and therefore prices fell quite dramatically. That really resulted in all sort of risks going off the table. So people believing that growth rates will collapse, and therefore a lot of trade and a lot of holding in equities across the globe is leveraged. That is, people borrow and they have invested. Hopefully not like the viewers who are listening into your show. And as a result of that, as soon as some auto triggers, and these are all algo-driven, computer-driven trades, that as soon as some levels, lower levels get hit, automatically the sale starts. And as a result of that sale, there is a further fall, and then the next round of triggers hit. And that seems to have started the fall. Thereafter, I think the coronavirus came in all its force in the last week or so, where world over people realized that this might require virtually a shutdown, and everybody to stay at home, and therefore impact on businesses and so on and so forth. So I think at this point in time, when we talk to clients and we explain to them what has happened and they understand what's going on, invariably the question that gets asked from more of the clients, there is one set of clients who say, let me take out all the money and put it in a fixed deposit and keep it safe. But there are more clients who are, after listening to the and understanding what has happened, are saying, can I put in the money that I have, because the markets have fallen. If something was attractive 1 month ago and it's down 30% from that level, can I not buy? So, I mean, at that point in time, also, our advice has been that just be careful. There is really no need to rush in, because I think you must understand that equity markets are based on only one factor, which is earnings of companies. With the impact of coronavirus, we really at this point in time do not know what the impact on earnings are. We know earnings will get impacted negatively, but how much and for how long is unknown. And therefore, we think that even if from a value point of view, let's assume for a minute that we've hit the bottom already. I think from a time point of view, there is some time before we hit bottom. So we might hover around this level, we might go down a bit and then go back up, we might go back up a little bit. But all that doesn't matter because there's no need to rush in with your investments at this point in time. So what really we are sort of telling our clients, Mubina, and that's what I think all the viewers should also know, that if you're dealing with an advisor, if you have a financial plan, if you have done a risk profile, and you know what your allocation between equity and debt is, and you're within that band, there is really no need to take any action at this point in time. So we do know that sometimes we get tempted that, when things happen, that why aren't we taking, why am I not taking any action? Uh, so taking a decision not to take any action is also a decision, and that's a positive thing that you probably need to take care of. What you might want to do is to look at the composition of your portfolio and look at any sort of scheme or instrument or holding which is inherently weak, which you feel that will not weather this storm, which will fall even more, then that's something that you can do, that you try and strengthen your portfolio at this time. So remove some of the weak stuff and then slowly start building the stronger stuff that you're intending to buy. That's on the equity side. If I look at the fixed income side, I think on the debt side, what immediately happened when oil fell is that yields fell in the market, and therefore your bond prices actually went up. So for a day or two, we actually felt, okay, equity is
I
down,
just
doesn't
want to
matter.
understand on that last bit when you were talking about equities. When you say identify the weaker ones, all right. Firstly, given the nature of the market, one would assume that the weaker ones will be thrashed even more compared to the stronger names in the equity market. So now, when prices are already so depressed, if one has to give one of those reviews to their portfolios at this juncture, would you advise them even doing such a rejig when values are so low?
So I think that the question really is that even if they are low compared to a level in the past, we do not know what's going to happen in future. So one of the things that you want to do at a time like this is to fortify your portfolio and make it stronger. So when I say weaker, I would imagine that if you are holding, let's say, equity stock of companies which are dependent on, let's say, group sort of behavior. So whether it's hotels, airlines, stuff like those, that that business is definitely going to get hit. That really doesn't make sense to be there, because when recovery happens, the sectors which are likely to benefit from this change, and obviously there'll be some benefits, right? We are seeing some technology firms, some of the firms where you are able to do business, home delivery businesses, some of those are starting to pick up. And I think companies which are more agile, which are able to adapt to change, will be able to benefit from this. They may change their business models totally, but how quickly they can change it is going to drive how quickly they recover. So my thought is that you get out of things which are going to take much, much longer to recover, and move into something which is probably going to be faster. So again, in your mutual fund portfolios, let's say you have a lot of small cap and mid cap schemes in your portfolio, and yes, they've fallen almost as much as the large caps have in this time frame. But you know that when recovery happens, when liquidity comes back to the equity markets, it will first go into the blue chips, and that will sort of ride the rally. And at least the one thing that you might get, may not get great, recovery of your money, but you might get better sleep if you are holding investments which you feel more comfortable with, than investments where you are worried all the time and saying, I hope tomorrow that stock goes up, that's when I'll sell it, or that particular segment moves up and that's when I'll sell it.
Okay, Mr. Navlakhi, now let's take forward that point which you were about to talk about, and that's debt. Now, I'm hoping that a lot of our viewers do have that little portion of debt as well in their portfolio, because usually when we say investments, viewers usually refer to it as equity mutual funds or equity investments, but it's important to have a little debt as well in the portfolio. Now, there as well, obviously, like we say, all asset classes have been hammered out of shape. So, what should those viewers do? The ones who have a little bit of debt in their portfolio, should they do any rejig? Because debt is usually for the shorter term. Secondly, if they do not have any debt component, do you think that they should add a bit at this juncture?
Yeah, so I think the impact on debt. So let's first talk about people who have had, debt mutual funds in their portfolio. So it's a good time to relook at the composition of those debt mutual funds, because the funds which have got credit risk in their portfolios. So there are schemes which are called credit risk schemes or accrual schemes. Some of those you have to look at the underlying holding of that portfolio, and if they are holding papers which have got some risks in them. So I'm saying, in the past, some of these companies and groups which defaulted or have got into trouble, like the DHFL group. There is a lot of talk about India Bulls. There is Yes Bank. So many of those, if they were holding that in their portfolio, and the proportion of that is abnormally large, then in case of a write down, if it's not already been written down, so if companies there are, which are double A rated, single A rated, uh, then you should worry about those. And I think that in fixed income, and especially at a time like this, you want your fixed income to be fixed, that you don't want to take risk. You want to ensure capital is protected. And therefore, we would recommend exiting out some of the riskier stuff. Never mind, some of those schemes are not yet long term. Uh, then it's good to get out. And the safe place to be is liquid funds, overnight funds, and really high quality bond funds. And I think that that is where possibly the benefit of working with a very good financial advisor comes in, where the person is able to go through and dig deep into the underlying of the portfolios and not just look at the names. Because as we know, with SEBI having recategorized, all names will look the same. All will say corporate bond, all will say dynamic bond, so on and so forth. But as long as they are in safer places, that's where I want to keep my money. For those who don't have anything in fixed income, then surely, yes, you can look at this, investing in fixed income. And my advice to people who have never done mutual funds in debt is always to start with liquid funds or overnight funds, because you've never experienced debt funds. So start with liquid funds, put some money in, withdraw some money after a few days, see how quickly it gets into your account, see the calculation of returns. They tend to be a little better than your savings bank rate for sure. And the advantage is that you have a 24-hour liquidity. So on a working day, if you made a redemption call, the next morning the money is in your account. So it's very, very safe. So start with that, and only then you start nibbling and going up the curve. Don't look at, I think many people might tell you, interest rates are going to remain lower, so let's go into government security funds, etc. They tend to be volatile. So just be a bit careful before you jump into those.
Okay, fair enough. Well, we'd also like to take this opportunity to invite our viewers. I'm sure they have a lot of questions and queries with respect to their mutual funds. Anybody, like Mr. Navlakhi as well said, who feels that they should take some action amidst all of this market panic, well, call in right now. We'll probably just assuage some of your fears. The number is 24990300. Any question or query you may be having, we will get that answered. Let's take on board our very first query. Rajesh Nayak has sent it in to us saying, I have 5 SIPs and a lump sum investment. Now he wants to know whether he should consider simply booking his losses, because obviously it's fallen quite a bit. How long the market may go on like this as well is his question. So he has 5 SIPs and 1 lump sum: Axis Multicap, Canara Robeco Small Cap, HDFC Equity, Mahindra Top 250, Murray Asset Emerging, and SBI Focused Equity. So it's a mix really of a multi-cap, 2 small caps / mid caps, and then you have 1 large cap as well. So firstly, these are the times when your lump sum investments are really tested, I suppose. Though he just has 1 lump sum, the rest are SIPs. But Mr. Navlakhi, his other question is, how long will the market go on like this? So what would you recommend Rajesh to?
So in 2008, in October, when the Lehman Brothers crisis hit and the markets were falling like 9 pins, they were down 35% in, I think, 27 days. I remember telling one of my clients that based on this run rate in mid-January of 2009, the market will shut down and it will be zero. And the client said, no, 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 that's not possible. So I said, yeah, exactly. It is not possible that it will become zero. But how long this will last is really, really tough to stick your neck out and give an answer. I think the medical fraternity is better equipped to give an answer to this, as soon as there is some level of certainty is where I think there will be some stability. So there is really no need to rush in and invest before that happens. With regard to your investments, I think the idea of doing SIPs is to build up long-term wealth. So when markets fall, you know that you're going to enter at lower levels. So it's a good idea to continue. I'm assuming that you have at least a 3 to 5 year window on that SIP. And in fact, if you can increase the amount in the SIP, this may be a good time to do it because you know at least it's getting parked for a long period of time. The schemes are pretty diversified. There are just a couple of schemes where the performance hasn't been really very good in the recent past. The HDFC Equity and the Mahindra 250 fund. So those are two SIPs that you might want to stop. I'm not sure you want to exit them at this point in time at this value. And then just earmark that money to among the other four schemes that you have and continue with the SIPs. Like I said, if you can increase the amount, nothing like it.
Okay, so that's the recommendation from Mr. Navlakhi. Rajesh, do take heed of that. Of course, don't do the rejigs right now. The values are a bit depressed. Okay, Mohit Gupta has sent in the next question for today. He says, I've invested 15 crore in the Franklin Low Duration Fund, in which there was a markdown of 100% in SL Infra and Reliance Infra, but they haven't done side pocketing yet. His 3-year XIRR was 8%, now it's 3%. His question is, should he exit? So it's a big amount, 15 crore rupees, that too in a low duration fund, which unfortunately was invested in a Rel Infra as well as an SL Infra, which has caused the NAVs of a lot of these debt funds to slump, and how. So unfortunately, we don't have the complete picture of where else is his money parked, or we would have been able to give a more holistic approach. But nevertheless, Mr. Navlakhi, is this a good time to leave this Franklin Low Duration Fund?
So I think what has happened is that if you look at the last few months, the AUM of this fund has been falling quite rapidly. Obviously, part of it is due to the fact that the type of paper they were holding was not all that great, and therefore returns have dipped. So my take is that if people are going to continuously take out money, then the quality of what they are holding will keep sort of dropping, because they will have to sell the more liquid investments and hold on to things which are riskier. So my advice would have been to exit this fund, but because the amount is large, maybe you want to do it in maybe 2 or 3 tranches if you wish. But I would certainly take out a large chunk of my portfolio right away. Maybe do another chunk next week if I want to wait for a week, because I think these amounts are large. So in case for whatever reason there is an impact on that fund, then you don't want your money stuck. So one thing I'd probably use this query to also share with viewers, that the one thing that you can do to protect your risk is not to have too much weightage in any single investment, whether it's a single stock, it's a single sector, it's a single asset class, it's a single fund manager, a fund house. I think all of these have got risks. And it's only at times like this that when you start focusing on risk. Otherwise, all the time you're focusing on return. And you possibly, when you invested in this fund, you realize that the low duration fund of Templeton had a YTM, or a yield to maturity, which was higher than most others. And the return was also better than most others, because obviously they were taking a little extra risk. And I think I keep repeating that in fixed income, the focus should always be safety first and return next. If I have to put a weightage, then the safety will have a much higher weightage than the return. But we tend to forget it in good times. So I do hope people will remember this always.
Okay. The key is, of course, to diversify, but that does not mean just adding 10, 15 funds into your portfolio. The consequence, of course, is right in front of you. We have an example, Mr. Gupta, who put in 15 crores in one fund. I hope this is, of course, not all of his savings. That is very essential. Okay, Rohit Gaur is calling us right now. He's joining us on the show. Rohit, good evening. Thank you for calling in. What's your query? Okay, I think Rohit's line has got disconnected. Reminder for our viewers, the numbers appearing on the top of your screens, 24990300. If you have any questions on what to do with your money, you can call in. In the meantime, let's take on board our next email query. We have Siddharth Mishra, who has written into us saying, I'm 41 years old, IT professional, and along with my wife, who's 37, have been investing in mutual funds through SIP and lump sum for the last 6 years. Current holdings is roughly about a crore and a half, 70-30, 70% in equity, 30% in debt. They want to amass 10 crores in 15 years for retirement and roughly 1.5 crores for their child's education. Now, it's a long list. I think there are 3 funds of ICICI, 2 funds of Kotak, another 2 funds of Axis, I think another 4 funds of Axis actually, DSP, Motilal, SBF Focus. The list is really, really long when it comes to their equity SIPs. Debt as well has roughly, I think, 8 funds, of Kotak, HDFC, Franklin, ICICI. So it's quite a long list. On one side, Mr. Navlakhi, we had a previous viewer who had perhaps not adequately diversified, but over here this young couple may have over diversified. Do you think that the number of funds that they hold, which is roughly, I think, just a quick glance at it makes me think it's, I think, almost 13 to 14 equity funds and 8 debt funds. Do you think that this is over diversification that may prove to be unfruitful?
Mobina, when I counted it, it came to 39. So it looks really, really big, and it is really over diversified. When you look at large cap funds, there are 3 or 4 large cap funds. And I think the important thing that you must know when you're investing in mutual funds now, because of the recategorization by SEBI, there's pretty much, an equal sort of holding that most fund managers may tend to have in each category. What I see is possibly missing is there is no index fund. And maybe when he started off, as he said, 6 years ago, there weren't too many index funds available. And we like index funds because we do know that actively managed funds are not going to be able to outperform, especially in the large cap space as we go forward. So getting some index funds may be a good idea. In terms of debt, I see a lot of weightage on Franklin. And as already replied to the previous viewer, because of the fall in AUM across many of their debt schemes, the risk in those schemes is a bit higher. And therefore, we would recommend that you should probably bring that down. He also asked a question about meeting his goals and therefore said he needed 10 crores in 15 years for his retirement. And I think that when I looked at that number, 15 years later, we basically look at a life expectancy of between 95 to 100 when you're planning for retirement, because that seems to be the reality. And as a result of that, we must know that this amount that he mentioned will take care of about 1.1 to 1.4 lakh per month, inflation adjusted, 15 years later. So to that extent, is that adequate, not adequate? I think that's something that he needs to certainly look at, that the 10 crores is only going to take care of 1.4 crores or 1.4 lakh per month for 40 odd years. If he gets 2% over inflation, it will be 1.1 lakh if he gets 1% over inflation. So I think when people do this calculation, it's amazing how they come up with a round figure. And it's invariably, that you've just put a lump sum and said this much should be enough for me to manage in my retirement. And depending on each person's lifestyle expenses, this amount will vary. So I think that this requires a little more of a detailed sort of analysis, and it's not really very easy to respond to this on television. And also what happens is that somebody else hears something that I said about one particular fund and says, oh, that means this is what I have to also do. But I may say it because of the proportion that the viewer has got. and I'm a little careful about that. So, excuse, I'm not going to answer the other parts of the question.
Fair. Fair enough. Okay, all right. We're going to try and answer as many queries as possible. So very quickly, I'm going to take on board our last caller for today. Mr. Das Rathi from Chennai is joining us on the phone line. Good evening. What's your question today?
Hello. Hello.
Yes, Mr. Rathi, what's your question?
Good evening, madam. Hello. Hello.
Good evening. Go ahead with your question, sir.
Yeah. I have 20 lakhs of investment in 6 mutual funds. One is SBI Blue Chip, SBI Blue Chip Fund, and then SBI Multi Cap Fund, and then HDFC Focused Equity, and then Franklin India Focused Equity, and Franklin India Prima, and L&T Focused Equity with the accumulation of 20 lakhs. So for the I have that is few months back my portfolio was 6 to 7% more than my capital. Now it is I think around 20 to 25% reduced. That is my capital was eroded.
Okay.
Shall I? That is I want money only after a year. Shall I continue?
Sure.
Shall I hold this mutual fund?
Okay, you need the money after a year. So, I mean, for that purpose, you would actually be considered as a short-term investor. Is there any chance, Mr. Rathi, you could push your time horizon? Okay, I don't think we have Mr. Rathi with us anymore. But yes, I think it's just a year. He needs the money in a year. Mr. Navlakhi, very quickly, what would you recommend he do?
So obviously don't do anything at this point in time. I think you have to wait for a bit of stability. Like I mentioned earlier in the show, if your requirement is within the next 6 to 9 months, then yes, you should provide for the liquidity to be in safe places. This is 12 months away, so maybe we have a window of 2-3 months, and hopefully we'll see a little bit of stability. I don't know whether we'll see a big rally. And at that time, we can probably review and decide which of these schemes to be in. I think the fact that he's put the money only 6 months ago, is from what I gathered, and he had only a 1.5 year or 2 year window, putting all of this in equity was fraught with risk. And he has a lot of focused equity. So these obviously are aggressive equity funds where they are going to select, which sector or which stocks they should be holding. And there is a good chance that, if they don't get the selection right, and in this market, frankly, we cannot blame fund managers for it, there would be a much sharper fall. So I think that's the only thing I feel that, too much of focused equity overall. But otherwise, he needs to wait through and take a call once things are a little more stable.
Okay, all right. Well, we're not going to be able to take any more questions or queries. Keep writing into us. We've got a couple of emails. I promise we'll get them answered over the course of the next few days. Mr. Navlakhi, always appreciate you joining us on The Money Show. Quick break. When we return, we are going to be talking about an insurance policy launched specifically for coronavirus. Don't go anywhere.